Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times bestselling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
Well, today we have an unusually full agenda. So first, my apologies to our listeners, but we'll not be taking questions today. We'll be sure to make additional time for your questions in upcoming webinars, so please keep sharing your thoughts with us. So, Jim, Greece has been the hot topic till just a few days ago, but as you predicted, there has been no Grexit. In fact, it transpires that the Greek government, for all its bluster, had really no serious contingency plans for leaving the euro. I'm left wondering, how close did we come to a real meltdown here?
Well, it's a great question, John, and an important one. And you're right. I mean, going back to 2010, 2011, at the start of this, I mean, remember, this whole Greek sovereign debt crisis started in 2010. Nothing new about it. It's been going through stages and quiet periods and intense periods for the past 5 years. But beginning in 2010 and continuing through this past weekend, I was one of the voices saying that Greece would not leave the euro. I think most voices were on the other side. They didn't see how they could stay in. Even today, I saw Austin Goolsbee, who was one of the members of the Council of Economic Advisors to President Obama, published a piece saying, well, okay, they're in for now, but in the long run, they can't possibly remain in. He listed a bunch of reasons. I thought he left out a couple. But the point is, no matter how many challenges are overcome, people just can't get their minds around the fact that this is Hotel California. You get in, you can't get out. There's no treaty provision, no legal provision for exiting. Now, that wouldn't stop a sovereign power from just unilaterally declaring they were breaching the treaty. That is possible, even though it would be messy. But as I said, I've always understood this not as an economic project, but as a political project. And once you see it as a political project with other goals in mind, then you can understand that the political will is there to keep it together, and indeed it has stayed together. So that's fine as far as it goes. But I will say, it's nice to get these things right, and some people have complimented that, and the temptation is always to take a victory lap. But the fact is, this was a lot more dangerous and came a lot closer to a Grexit than I would have thought. In other words, I got the result right, but the process was a lot more challenging. I was up late Sunday night, of course, Sunday night New York time. That was early in the morning Monday in Brussels. The summit conference, they actually set a record for the longest Euro Summit conference. It was over almost 24 hours of continuous meetings. And there was some pretty good reporting. You could pick things up on Twitter from some reporters who were outside the room. So you were getting, as close to real-time information as you could. But I'd always felt that Germany and Greece would both blink, that they both considered that a Grexit, Greece leaving the euro, would cause more harm than whatever it was they had to go through to keep Greece in. But in the end, Germany didn't blink, or at least not very much. It was Greece that had to do all the concessions, and it became apparent that Germany was prepared to see Greece leave. Now, I've been in a lot of tough negotiations, and the only way you get a good result in any negotiation is if you're prepared to walk away. If you make it clear at the table that you'll pay any price or do anything, or whatever it takes to get a deal done, then the other side will take advantage of you one way or the other. You have to get a good deal, you have to be prepared to let the deal go down. And that was always dangerous as far as the euro is concerned, because I took the strong view that there would be no Grexit. But I also said, if I'm wrong and there is a Grexit, it's not going to be contained. It's not going to be the non-event that a lot of people were expecting, that it would be catastrophic in its consequences. And that became very apparent Sunday morning when markets seemed to be a little bit complacent. But when it was obvious that Germany was prepared to see Greece go, and then you started to think through what that meant. I mean, the only way I could understand it was Germany understood the consequences, but they felt that it would really be bad for the rest of the world. In other words, it might be the United States and certainly the Greeks themselves who would have to bear the brunt of it rather than Germany. And there might be some truth to that. So the good news is Greece did not leave. There was no Grexit. The Eurozone has held together. I expect that will continue to be the case. I expect that they will add new members. I went through this in some detail in Chapter 5 of my book, The Death of Money. If anyone who read that book last year would have sort of seen this coming or seen this outcome coming, because I outlined it in some detail. And so I expect that will continue to be the case, but it was a far more dangerous situation. I would say that late Sunday night New York time was the most critical, most dangerous moment in global capital markets since the Lehman Brothers weekend in mid-September 2008. So we've come, it didn't result in a collapse. The world didn't actually fall apart, but it came dangerously close. So I guess I would say I'm glad that we got the call right, but it did look a lot more dangerous than I thought, and that's something that should bear watching in the future, because that danger has not really gone away.
Well, there's one footnote to the Greek story that you picked up in your newsletter, Jim, Strategic Intelligence. You report that in response to the crisis, Greece banned the sale of gold to its citizens. And that may be a point of interest to our listeners here. Have you got any comment on that?
Sure, I did notice that. It was very typical of what governments do in a crisis situation, because and we all know that the banks were closed and the ATMs were reprogrammed to allow 60 euros a day, and we all saw the lines of Greek citizens lined up to get the 60 euros, roughly $100 or so out of the banks. I will say, when I saw those pictures a week ago Sunday, I thought to myself, well, certainly you feel a lot of sympathy for the people in that situation. But I thought to myself, gee, what were you waiting for? Couldn't you, you could see this coming a mile away. Why weren't you at the ATM, a month ago, 2 months ago, 6 months ago, a year ago, getting some cash, putting in a safe place for this contingency, for exactly this kind of thing? And I can see this. Look, this has happened in Cyprus. It's happened in Greece. It will happen again. I can see this happening even in the United States in the next financial crisis, one that I expect will be worse than 2008. So, but that brings us to gold, which is, okay, so you get your money if you can. That's easier said than done. But what do you do with it? And the authorities did not want people buying gold. You could see, because you could say, okay, I'm going to go get my euros out of the bank. I'm a Greek citizen. I don't trust the Greek banks. I'm going to get my euros out of the bank. But what would happen if Greece was kicked out of the euro and the euro itself collapsed? Now you've got, two layers of risk. One, your own banking system, but two, maybe your euros aren't going to do you any good, because those two things are correlated. It's a lot like, when you work at a company and they offer you a generous stock purchase plan, and, you buy the stock and you think that's a good investment, like the employees at Enron. Then you wake up one day and find that the company's failed. Well, you get a double wipeout. You lose your job and your net worth at the same time, because by buying your own company's stock, you've doubled down on the company, and if it fails, you lose your job and your investments at the same time. So there's a sort of conditional or hidden correlation there. And the same thing could be true for the Greek citizens. They were lucky to get the euros out of the banks, the ones that could. But just because you got your euro doesn't mean you're home free, because if Greece quit, then the euro itself could fail. So you're kind of doubling down. So what's the way out of that? Well, one way out is to buy gold. Now, at least you're protected against both the Greek banking system and the euro failing, because gold's not correlated to either one of those things. In fact, gold, I think, could be expected to go up in that kind of catastrophic outcome. But the authorities, of course, don't like that. They probably weren't happy with the 60 euros a day or anyone who was hoarding cash, but they at least felt, well, if we stabilize the system and do the deal with Germany, then those people will show up and put the money back in the bank. By the way, that's exactly what happened in the United States in 1933. As this Greek bank holiday was going on, it was day 5, day 6, day 7. I was reminding people that so far, at least, the Greek bank holiday had not lasted longer than the U.S. bank holiday. In March 1933, the U.S. closed all the banks. Of course, there were no ATMs then, so you couldn't even go to the ATM and get $100. The banks were just closed. And when they closed the banks, President Roosevelt did this by executive order. When they closed every bank in the United States, they did not say when they would reopen. Now, it so happened that they reopened about 9 days later, But they didn't say that at the time. They just said they're closed until further notice, and we'll get back to you about when they would reopen. Well, the reason they closed them was there was a run on the banks. People had completely lost confidence in the banking system. They were running down, getting all their money out of the banks, putting it in coffee cans, shoe boxes, burying it in the backyard, under their beds, mattresses, whatever, but they were taking the money out of the banks. Well, a funny thing happened. So we had the bank holiday, so you couldn't get your money out any longer. The 9 days went by. During that period, the government went through the exercise or the appearance of examining all the banks. Now, whether they actually examined the banks, I don't think they examined very many, but they were at least able to go through the motions, kind of like Tim Geithner's stress test, and then announce that the banks that were sound, the ones that were reopening at least were sound. Well, then people lined up to put their money back. So the banks were closed because it was a run on the bank. Everyone was taking the money out. But then after they reopened them, because confidence had been restored, people put their money back. So I'm sure the Greek authorities were hoping for the same thing, meaning people would take the money out, but once things stabilized, they'd come back down to the bank and put their money back in. But there's a problem. If you buy gold, that's it. Now you're in gold. You're not going to walk up to the teller and hand them your gold. So the authorities wanted to ban the sale of gold because gold is a kind of a one-way street. I mean, you can always sell it, but you're much more likely to hang on to it as a form of insurance, which is a good reason to own it. Authorities hate gold. Central bankers and bank regulators and mainstream economists hate gold because once people buy gold, they tend not to sell it. They tend to hold on to it, just kind of keep it, as your protection against various catastrophic outcomes. So we'll see that again now. I look at Greece and look at Cyprus. To me, these are dry runs for the same thing on a much larger scale. And whether it's in the UK or the United States or Canada, it could be a lot of countries around the world, but these things are being tried out. The bail-in, the reprogramming of the ATMs, ban on gold sales, all these things are being tried out on a small scale, and they will be used on a much larger scale in the next financial panic, which is one reason, going back to the people lined up at the ATMs, I say, what were you waiting for? You should, get your cash now if you want cash, get your gold now if you want gold. Don't wait for the lockdown.
Jim, turning from Greece to China, where there's been some measure of recovery from the stock market collapse, which, of course, we were all following with great interest. But how serious was this collapse? It looked huge on the charts, but after all, the fall in values was only to levels seen as recently as March this year. Is the bigger story perhaps the zealous interventions of the Chinese authorities?
Well, John, I think both stories are big, and let's just take them separately. First of all, I would not refer to this crash in the past tense. It's actually just starting. I was on television last fall looking at the Shanghai Composite Stock Index, and I said, this is a bubble that's going to crash. To me, it was very apparent. Bubbles are not that difficult to spot. And when it did crash, I, called attention to that. I said, hey, I was out there a while ago saying this was a bubble that was going to crash. And somebody immediately came back and pointed out that the level at which I made that forecast was actually below where it was after the so-called crash. In other words, if you had ignored me and bought the stocks, you still would have made money. And the point is, I'm not in the business of picking tops and bottoms. I'm not in the business of picking exact turning points. I am in the business of analyzing system dynamics and trying to understand where those dynamics are going so that we can stay ahead of the curve and not be surprised by these things, whether it's Greece or Chinese stock market and so forth. So your point, John, is, okay, it's off the top. It crashed pretty hard, about 30%. But even at the 30% level, it ran up so much that even after going down 30%, it's still above the level where it was at the beginning of the year, and that is correct. But it's not over. When bubbles break, they don't go straight down to the bottom. They go down, then they bounce up, and then they go down again, and then they bounce up a little bit, and then you get people say, buy the dips. They buy the dips, and it goes up, and then it goes down again, and some people say, well, there's another dip, buy the dip, etc. No, it's a process of denial. It's a process of stages. It's an irregular process. It doesn't go straight down. So what I would suggest that analysts do or investors do, if you're interested, is take two stock charts. And you can do, they actually look very similar. Take the Dow Jones Industrial Index from 1927 to 1933, or take the NASDAQ stock market from 1996 to 2001. Either one of them will do fine. And then overlay it, just normalize it and overlay it on top of the Shanghai Composite. And what you'll see is that the run-up looks very similar. It gets strong, it gets momentum, and then it goes hyperbolic, and then it goes straight up, and it gaps up, and then it breaks. But what you'll see is that Shanghai is nowhere near a bottom. That the bottom in the U.S. stock market, I mean, everyone remembers October 21st, 1929, when we had the two-day stock market crash, when the stock market went down almost 25% over a two-day period. That was just the beginning. That stock market didn't hit bottom until 1933. It took 4 years to grind its way down. It was down 90% by the time it was done. Not 20% or 30%. It was down 90%. The same thing with NASDAQ. NASDAQ broke in January 2000, but it found its way back, and not to the old high, but went up a little bit, ground down a little bit. And then it broke sharply and ended up down 80%. So if you look at those stock charts and look at what's going on in Shanghai, I would say that this crash has just begun. Now, the government has used, coming to your second point, the government has used extraordinary measures. I think they're fairly well known. They banned short selling. That seems to be the first thing everybody does. Then they told institutions they were not allowed to sell at all. Then they limited margin accounts. They did a whole host of things to basically stop the fall. They came up with a $19 billion investment fund. So they got all the brokers to buy stocks. They told the institutions they were not allowed to sell stocks. They eliminated short selling, and they did a number of other things. And who knows what they did that we don't know about. So it's an extraordinary effort. It hasn't really worked. I mean, it stopped that crash kind of dynamic. It sort of put a floor under it. It hasn't really caused it to rally very much. I wouldn't expect it to. This process is just beginning. So yes, it is very serious. Now, it doesn't mean, by the way, that the Chinese economy is falling apart. The Chinese economy growth has slowed down a lot, and that's a big deal for the world because they are about 10% of global GDP. But the economy hasn't ground to a halt. This is a stock market crash and a capital markets problem, and a lot of individual investors are getting wiped out. And it could be a social problem for the Communist Party and the authority of the Communist Party. So I would watch it very closely. I expect it to go down a lot more. It's far from over. It has that dynamic to it where I would expect it to go down another 50% from here. But, it'll go up and down a little bit and fluctuate a little bit. This is really just beginning, and it's a serious problem for people who threw money into it. Meanwhile, the elites, the princelings and the senior Communist Party members and the CEOs and owners of the state-owned enterprises and other, mega wealthy in China, they're getting their money out as fast as they can. They have been for years, by the way. I talk about this in chapter 4 of The Death of Money. I travel around the world quite a bit. Just go to, Vancouver in British Columbia, or Melbourne, Australia, or Istanbul, Turkey, or London or Paris. I was just in London and Paris last week. And you hear the same story, the exact same story. High-end condos are going through the roof. They're being bought up by Chinese, among others, maybe some Russian oligarchs and South American drug lords, but mostly Chinese money. And so you have to be connected to get your money out of China. Like the average, even if you're sort of upper middle class, maybe you own 5 McDonald's restaurants in Wuhan, or maybe you own a chain of 7-Elevens in Chongqing, or you own a car dealership in Shanghai, and you're not poor, but you're not mega wealthy. You've got maybe a few $1 million saved up. You cannot get your money out of China very easily. But if you are mega wealthy, if you're worth 100 million or 500 million or billion, as many of these Chinese princelings are, then either through corruption or the ability to have offshore companies, or transfer pricing, or rigging fake losses in a casino in Macau. There are a lot of ways to do it, but they get their money out of the country. Well, what does it tell you if the smartest, richest, most connected people in China are getting their money out? How much confidence do they have in their own economy? And that's what I see. So the stock market is a problem, but it's not the only problem, and there's just a lot of rot in that society. You could be looking at social unrest down the road. And I just say I think the stock market has a long way to go down. I wouldn't invest a nickel in China. There are other reasons for that, by the way. If you're a large business, they steal your intellectual property. China's a fascinating story. That it's an old culture and a strong economy and an important player in the international monetary system. I watch it really from that global macro international monetary perspective, but it's just got so many problems and so much opaqueness that I wouldn't recommend anyone investing in it.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.